People are going to keep investing in it, but it is going to die back down. The top 1% are going to withdraw their money in quarter one and spend it on stuff. And then quarter two, it's going to be at its lowest. And then people are going to start reinvesting in it in quarter three. And it's going to peak between quarter three and quarter four. And if you want to ride that little dip and get you a little $20,000, $30,000 increase, or if you're buying in small and you're looking at a 50% increase in that little dip phase, get your little 50% increase, because you don't have to put it in there and ride the wave for the full 80% annual interest rates that they try to guarantee you. You could go in there and get your 50% interest rate on Bitcoin. Doesn't change the fact that because of the volatility of Bitcoin, you could actually go in there and come out with a larger quantity of money in a shorter period of time and then hold it. You can hold it. You can cash out and then hold it. And it'll be the foundation of when Bitcoin tanks. You'll be able to say, all right, now let's go back and go in all over again. But if you're willing to accept the higher risks for potentially higher rewards, you can consider investing in cryptocurrencies. And if you start with a reputable coin like Bitcoin and cross trade with Ethereum, you be able to maintain the volatility between the two stocks, but you also have to be prepared for the ups and downs of the volatility there. And these are going to be ways that you could take $200 and throw it in. And like I said before, if you throw $200 into Bitcoin, if you would have threw $200 into Bitcoin before they picked the president and let it ride for that week and a half, 2 weeks, you would have definitely gained 200% on your $200. It ain't a lot. You would have put up $200 and you would have walked out with actually, no, I'm wrong. You would have gained a 50% increase because it went from about 60,000 to about 90,000. So you would have went from about 200,000 to from $200 to about $300. But you would have made a quick return in less than 30 days. You would have made a quick return where you could have pulled that $400 out and said, I made some money off Bitcoin. And it actually would have fueled your ability to want to invest. For the long-term investor, you have to have a strategy. You have to have a plan. So one of the other things that I've told you guys plenty of times before in the last few weeks is if you're doing peer-to-peer lending, you have the platforms like Lending Club that allow you to lend a small amount of money to individuals or small businesses in exchange for interest payments. I told you guys something equivalent to this, where you have higher returns for these are going to be more higher returns than a traditional savings accounts, but you will have higher returns doing something like this than what you would with putting it in index 500s. But because of the volatility and the risk, you got to look at, whether or not you want to, you have the tolerance and the financial capabilities to lose out on that money, because you're putting money into the faith that somebody's going to pay you back. And if they do pay you back, then you make massive returns. But if they don't pay you back, you take it as a loss. And for those of you who've ever borrowed money from a cash advance place and never paid them back, or got a loan and didn't pay back the loan, or borrowed money from a lending establishment knowing you didn't have the money to pay it back, and even if you did find a way to make the money to get it back to them, you were one of the few people who could be trusted to lend money, but that borrower took a big risk on you. And the fact that you didn't pay back your loan and you said, screw it, charge it to my credit score, that's the risk that lenders take. But the lenders that vet their borrower and lend responsibly are more successful than they fail, where they still can take losses that are tax deductible off of their gains when they're lending money. But you're going to get more returns off of lending money that's going to be more stable and non-impacted by the stock market. For example, when you're doing short-term loans, you have short-term loans that allow you to charge monthly interest rates instead of annual interest rates. So you might be charging 19 or 20% or 30% interest rates like credit cards on a large quantity of money that you lent to somebody that turns into an annual return of 300 to 600% interest. If you loan somebody $10,000, and because of the monthly interest rates in the contract, it's compounded monthly, they would end up owing you off of that $10,000, $30,000. They would be making payments with you for so long that you would have paid double or triple the value of the money that they originally borrowed. That's how they make their profit. So every now and again, somebody who doesn't pay, it doesn't really hurt their bottom line because they have set up a system where, if I can get this person to pay me 8 payments or 10 payments, they've given me back the principal. Now I'm just working on profit. Used car dealers do the same thing. They pick up a car out of the auction, they hold the car, put it up for sale. Somebody puts down a down payment on the car and then starts making monthly payments. After that person has crossed over the first 6 to 8 payments, they've paid off the total value of the car from the auction, and now the company has broken even. Every payment they've made after that positively impacts the credit. It positively impacts the business, but it positively impacts the credit of the person who's borrowing. So when that person decides to go back to that entity and say, I want another one, I can count on you to pay the whole deal. Whether you pay it up front or whether you make payments, I can count on you to pay the whole deal. So 2 things I can do for you. I can break you off on a chunk of change and take a bunch off of the value of the car to kind of make it more affordable for you. I can work some magic, get you one with more value. All these things can happen because they've earned your trust, so that increases their borrowing power. Banks aren't that easy to persuade, and that's why private investors and private lenders are the way to go, because banks have an underwriting department that's very strict that prevents the banks from having as much capital losses as private lenders. But private lenders have the ability to be more financially successful because you can charge higher interest rates for more volatile borrowers. Take a risk on a surefire thing. And this is going to give you high yields. So when you're dealing with high yield savings accounts, this is another way to go. High yield savings accounts or CDs. You're probably going to see more high yield checking accounts these days over CDs and high yield savings accounts, because savings accounts are usually giving you a little bit above market average, 1 to 2%. They're not always giving you 5 and 10%. The checking accounts are giving you incentivized 5 and 10% for up to like $500 in most accounts. Some of them are $200 or $300 in the account. And the ones that are more than $500 are typically only doing it for a limited period of time as soon as you open the account. And then after that, it's going to go back down to 0.54 or 0.64%, which is less than 1% of the value of the money. And it's not really worth investing. Leaving it there once you've invested in that, you might as well just take the money out once the time period's rolled over. But why not, as a high returner, as stock or crypto, place your money into high yields accounts or certificates of deposit where you can get better interest rates than standard savings accounts with minimum risks. Certificate of deposit accounts, or CDs, are going to be ways where you could put your money into a location and leave it there for a limited period of time. It's going to be a fixed period of time. They're going to charge you penalties to take your money out early, but you will be able to put your money into that that account and turn over a larger quantity of revenue, where you would be able to see yourself with a more effective and more innovative portfolio. Now, there are many other investment options available, from mutual funds to index funds and even cryptocurrencies like the Bitcoin, as we've talked about earlier. And they have Black Coin. Somebody says something about Diddy Coin. I don't know why you would even have a Diddy Coin. They have US currency coin. They have rainbow currency out there. So there's a lot of cryptocurrencies out there that you can look into. And some of them are growing in popularity, not quite up there with Bitcoin, but you start looking at how Bitcoin can be cross-traded against the top 5 cryptocurrencies. When you find a coin that fluctuates inversely to Bitcoin, when Bitcoin goes down, that coin goes up, you can actually buy and sell against that particular type of currency and have even higher returns. But the key that you need to have for these types of endeavors is to educate yourself. You got to do the research. You got to start small. Don't be afraid to experiment and try new things. And that's how we're going to learn and grow. Firstly, it's the power of starting small, and then you want to be consistent.